Not long ago, the phrase strong earnings meant something very simple. A company made more money than expected. Revenue was up, profits were growing, margins looked healthy, and investors rewarded that performance with higher stock prices. It was a fairly straightforward relationship, but today, that same phrase, strong earnings, doesn't carry the same meaning it once did. Companies are still reporting solid numbers. Headlines still highlight revenue beats and profit growth. But behind those results, something has changed. And understanding that shift is becoming more important than the numbers themselves. Because in today's business environment, strong earnings don't always mean a company is as strong as it looks. To see why, you have to look at how companies are actually achieving those results. One of the biggest shifts has been the growing role of cost control. Over the past few years, many companies have faced rising expenses, higher wages, increased supply chain costs, more expensive energy, and ongoing inflation pressure. Instead of relying purely on growth, businesses have responded by tightening operations. They've reduced headcount, slowed hiring, cut back on expansion, and streamlined internal processes. And in many cases, that has worked. Costs go down, margins improve, and earnings look strong. But here's the catch. Those improvements are often coming from doing less, not necessarily from building more. In other words, a company might report higher profits not because it's growing faster, but because it's becoming more efficient or more cautious. That's a very different kind of strength. Another major factor is pricing power. Over the last few years, many companies have raised prices to offset higher costs. In some industries, they've been able to pass those increases directly to customers without seeing a significant drop in demand. That has boosted revenue and supported earnings. But this strategy has limits. Consumers are becoming more sensitive to price increases. In some cases, they're starting to push back, buying less, switching brands, or delaying purchases altogether. So while earnings may look strong now, they might be supported by pricing decisions that aren't sustainable long-term. There's also the impact of financial engineering. Companies today have more tools than ever to manage how earnings appear. Stock buybacks, for example, can reduce the number of shares outstanding, which increases earnings per share even if total profit stays the same. That can make performance look stronger without any real change in the underlying business. Similarly, companies can adjust spending, delay investments, or shift costs across reporting periods to smooth out results. None of this is necessarily misleading. It's part of how modern corporate finance works. But it does mean that strong earnings can reflect strategy as much as performance. Then there's the issue of expectations. Earnings are always measured against forecasts. If analysts expect a company to perform poorly and it does slightly better than expected, that's technically a beat. But that doesn't mean the business is thriving. In some cases, companies are beating lowered expectations, not exceeding strong ones. So the headline might say earnings beat, while the underlying reality is more modest. At the same time, the market itself has changed. Investors are no longer focused only on growth. There's a greater emphasis on profitability, cash flow, and sustainability. That has pushed companies to prioritize stability over expansion. As a result, many businesses are deliberately slowing down. They're choosing controlled growth, higher margins, and predictable performance instead of aggressive scaling. That can produce strong earnings in the short term, but it also reflects a shift in mindset. The goal isn't just to grow, it's to survive volatility, and that brings us to a deeper change. The definition of strength in business is evolving. In the past, strong earnings often meant a company was expanding, hiring, investing, launching new products, entering new markets. Today, strong earnings can mean the opposite. It can mean a company is holding back, protecting margins, reducing risk, focusing on efficiency rather than opportunity. There's also the broader economic environment to consider. Uncertainty has become a constant factor. Interest rates are higher, capital is more expensive, demand is less predictable, and global supply chains are still adjusting. In that kind of environment, companies are making more conservative decisions. They're prioritizing short-term stability over long-term bets. And that shows up in their earnings. So when you see a company report strong results, it's worth asking a different set of questions. Where is that strength coming from? Is it driven by real growth or by cost reductions? Is revenue increasing because of higher demand or higher prices? Are profits improving because the business is expanding or because it's pulling back? These questions matter because they reveal the quality of earnings, not just the quantity, and that's becoming the real focus. Another important shift is how companies communicate their results. Earnings reports today are as much about narrative as they are about numbers. Companies highlight efficiency, resilience, and discipline. They talk about navigating uncertainty and managing costs. These are all important themes, but they also reflect the environment companies are operating in. A strong earnings report might sound confident, but it often carries an underlying message. Things are harder than they used to be. That doesn't mean businesses are struggling across the board. It means success is being defined differently. It's less about rapid expansion and more about control. Less about chasing growth and more about protecting what's already there. And that changes how we should interpret the numbers. Because strong earnings today don't automatically signal momentum. Sometimes they signal caution. Sometimes they signal restraint. And sometimes they signal a company adapting to a more complex and uncertain reality. So the next time you hear that a company delivered strong earnings, it's worth looking beyond the headline. The numbers might be solid, but the story behind them is what really matters. Because in today's business landscape, strong earnings don't just reflect how much a company made, they reflect how it chose to operate and what it might be preparing for next.